if you're listening in, then you're one, interested in crowdfunding or interested in the updated rules that are happening in March. And so we pulled together a panel of the ages to talk about the new rules regarding crowdfunding. And so we have, so far on stage, we have Chuck, who is the CEO of Republic Crowdfunding Platform. We have Martha, who works at the SEC as a small business advocate. And then we have Johnny, director of fundraising at WeFunder. We have a whole bunch of other fun folks that are coming in to join us. And I do want to say that we are recording this conversation, and we will be sending this out to those that have registered. So you can register. Let me pull up the link to make sure I'm telling you guys the right thing. You can register at lu.ma/new CF rules. So if you want the recording, please feel free to register there, and we will be sending that out after the show. I believe Martha will also be posting this on the SEC YouTube page. Is that right, Martha? Or somewhere?
Yeah, we'll be posting it on our website.
Perfect. So there'll be multiple places where you can get it. But if your friends are not on Clubhouse and you think that they would really, really enjoy this conversation, you can have them sign up. You don't have to be on Clubhouse to register for the show tonight. But then you can also find the information on the SEC website. I believe when I spoke to Amy, she said at the end of the week or next week. Oops. Sorry, Harold, I accidentally moved you to the audience. I'm so sorry about that. Okay, so Harold is the co-host. We're co-hosts tonight. I moved him to the audience by accident. Sorry about that. But I guess we want to jump start and get into intros. Harold, I made you a moderator, so you should be good to go. Harold, do you want to give a 30-second introduction of who you are, and then we'll go round robin?
Yeah, for sure. Thanks, Sandra. Sorry I'm a little bit late. Hey, everyone. My name is Harold Hughes. I'm a startup founder. My company, Bandwagon, is headquartered in Greenville, South Carolina. We are helping live event organizers, experience creators, help their consumers better manage their identity information. Obviously, there's a lot of stuff we can do beyond that. I'm based in Austin, Texas, though, as a remote CEO. And so I was running a little late due to some of the stuff that y'all have probably seen all across Twitter and social media. So, before going into, or instead of going into other stuff, I just have an ask. If you're in the means and ability to make a donation to the Austin Area Urban League, please click the link, or click my bio. You'll see that you can text Austin to 707070, and you can make any amount of donation. But other than that, I'm an equity crowdfunding alum. I raised money on Republic. I've backed several campaigns on the various platforms, starting in WeFunder, the Republic, and many others. And so this conversation is near and dear to my heart because I think it's going to be great to talk about democratizing access to early stage capital for the startup as well as the investor. So, Chandra, I'm super excited to be here. Thanks for having me, and I look forward to hearing from our guests tonight.
Thanks, Harold. And we'll have you repeat that code during the show because I want folks to be able to help if they can. Chuck, and then we'll go to Martha, Johnny, and Howard. 30 seconds introduction. Who are you and why are you here?
Thanks, Sandra. I'm happy to be here. I'm Chuck Pettit, CEO of the funding portal at Republic. What that means is I'm responsible for the infrastructure that helps bring companies to the crowd, from sourcing to diligence to onboarding operations, legal, marketing, you name it. We have been in business for about 5 years at this point, and investment crowdfunding is very near and dear to my heart. It was one of those no-brainer situations that came to my attention from the team at AngelList about just over 5 years ago, and I'm loving every second of it. I'm excited to share some more information. Lovers and haters can email me, chuck@republic.co. I answer those messages personally. No assistance, no computer. So feel free to reach out to me whenever you want.
Thanks, Chuck. Lovers and haters can reach out, huh? Love that. Martha, 30-second introduction.
Wonderful. Thank you, Chandra, and thank you, Harold, for making time with everything going on in Austin. I've been thinking about you. I am Martha Miller, for those that I have not had a chance to meet yet, and I spot some familiar faces in the audience. I am from the U.S. Securities and Exchange Commission and have the pleasure of leading a new office that was created as an independent office at the SEC to improve the rules for capital raising, working collaboratively with policymakers across D.C., and we are particularly focused on underrepresented founders' experiences, including women and minorities. I am thrilled to be here today to do a lot of listening and a little bit of answering questions, and I appreciate you guys convening it. And I also, because I come from the government, I come with a lovely disclaimer. But I'm here today as Martha. I am not here today speaking on behalf of the entire agency, so just take things said with a grain of salt as my own statements.
Love that. Johnny?
Yeah, absolutely. Johnny Price here, originally from the UK, lived in San Francisco the last 10 years, but my wife and I and 3 beautiful young kids just moved to Nashville, Tennessee at the start of the pandemic. So speaking to you from here in a very snowy Nashville, I lead the fundraising team at WeFunder. I've been here for 3 years. Before this, I founded the US team at a nonprofit called Kiva.org in San Francisco. We were bringing Kiva's model of crowdfunded microloans to support US micro entrepreneurs. But now it's my privilege to lead growth at WeFunder. I work here really for our charter. If you go to wefunder.com/charter, you can read our public benefit corporation charter, which I'm sure we'll get into as we talk more about democratization of access to capital in this conversation.
Thanks for that, Johnny. I had no idea that you moved to Nashville. Dropped that little bomb just then.
There you go.
Howard, can you give us a 30-second intro?
Yeah, thank you, Chandra, and thank you for organizing this event. I'm Howard Marks. I'm the CEO at Start Engine. Our mission is to help entrepreneurs achieve their dreams. Our company is in the equity crowdfunding business, taking advantage of the JOBS Act that the SEC has put in place since 2016 on to today, which is very exciting with the new changes they're making. We've helped over 600 companies crowdfund, raised close to $300 million for those companies. One thing to note is that 10% of our founders are African American, men and women, and about 26% of the founders are women-led. So we feel particularly good that we're starting to make some progress in making sure that the representation and access to capital is for pretty much the United States as it exists today. And so I'm particularly excited to be here today because I want to convey and educate to the people listening how amazing this new form of capital raising is for entrepreneurs who are looking to build their dreams.
Thank you, Howard. I just want to take a second and make sure the audience understands how amazing it is to have everybody here today. So we have, we talked about this, right? We have Martha from the SEC, and then we literally have directors, CEOs from the 3 largest, most popular, I don't know the correct adjective, crowdfunding platforms. And they're all here in one room. So I want to make sure that I state that for the audience to understand how huge this is. And so how this is going to work is Harold and I have put together a list of questions, and we will be going back and forth asking the folks on stage their thoughts and opinions on those questions. And then we want to actually we're not going to open the floor up to bring folks up, but if you do have questions, you can DM me or Harold. And then we also have a hashtag that you can use, which if you click in my bio, I put the registration link in my bio, and the hashtag is exactly what it is after the /. So new CF rules is the hashtag that you can use on Twitter if you have any questions, or you can DM Harold and I, and we'll ask those towards the end. But I'm going to throw it to my co-host, Harold. What's the first question that you have for the panel?
Thanks so much, Chandra. Yes, and I'm sharing it as well. So if you're in the audience and want to share some the notes you're hearing or some of the thoughts, feel free. That is completely okay with us. Just use that hashtag new CF rules. So my first question is probably going to best start with Martha. Obviously, we're all really excited about the new rules and the regulation CF limit being increased. I wanted to get your thoughts on what was thought that went into raising it to that amount, and then also in general, what types of impact should we expect to see due to the changes in office politically? Will that likely still happen in March, or will it be delayed? What are you thinking about that as it relates to the new rules?
Harold, I like it. You're coming in with the big questions.
I gotta keep the people here. That's the thing.
Hey, I like it. You gotta start out strong. So, for those who are catching up to speed and thinking, okay, the rules have changed for crowdfunding. Hold on, I thought I just got used to the ones that came about a few years ago. Dollars from investors online. And the SEC approved rules and adopted final rules this fall that are slated to go into effect on March 15th, so less than a month from today, that make a number of different changes that were intended to address some of the critiques that were leveled at crowdfunding. One of the biggest ones being that you were only able to raise up to about $1 million. And so now, after March, you will be able to raise up to $5 million in a single offering. There's also some additional tweaks to the mechanics, including allowing companies to gauge market interest, otherwise known as testing the waters, some updates to investment limits for investors, and permission of special purpose vehicles. That's the very high-level summary of the changes. And to the second question that you asked, what can we expect with things coming forward in March? For those who are keeping up with their politics and things happening, you have probably seen that there was a regulatory freeze memo put out by the White House. I think that's what Harold's referring to, shortly after the inauguration of President Biden, that put into a freeze in effect on some later regulations. And it's important to note that the SEC, like all of our federal financial regulators, is an independent agency, which that means that typically the SEC is not subject to executive orders that apply to other agencies. And so what that boils down to, the short answer is if an amendment was made, like this was for crowdfunding via rulemaking with the commission, the same thing would need to be happened. So it would actually have to go through the amendment process for those changes to be changed and to not go into effect in March. So welcome opening it up, and would love to hear thoughts from others here. And Harold, Sandra, I'll defer to you on how to do that. About what are your thoughts about how these changes will impact founders? Because I think the what is something that the SEC is very well equipped to look at, but the how really goes to the feedback that I know a number of folks, including the portals who are here today, raised with us. So would welcome them talking a little bit about how they see that coming into effect.
Martha, that was actually, sorry, go ahead, Harold.
No, I was going to just say that's perfect, and I think that asking the folks who are representing the various platforms how not only are they preparing their founders who are currently raising, and maybe ones who have raised in the past, but also what are you doing to prepare your teams to get ready for this new potential influx of folks who may have said, at one point, 07, I'm not really interested, but at 5, now you've got my attention. But Chandra, go ahead, and then we'd love to talk to Johnny, Howard, and Chuck on that.
I was just going to say, Martha just set it up perfectly. That was literally one of the next questions that we wanted to ask. So Chuck, Johnny, and Howard would love to hear your thoughts on Harold's comments and Martha's comments.
Yeah, I'll say I'm sure Howard and Johnny agree that our work really started several months ago, if not 6 or more months ago, when these things started to come to fruition, and it was going to happen, or we felt confident that it would. Immediately you saw a lot more people, knocking on the door to inquire about Reg CF for the first time. A lot of their stakeholders, including their boards, their current investors, even third-party service providers were telling people to look into it. So there's a massive increase of inquiries in people that were basically, being educated for the first time, and only because the rule changes or the potential rule changes caught their attention. One of the things that we focused a lot of our time on for a while now and recently is the product changes that are required to come with these rule changes. it sounds simple that you can test the waters, or it sounds simple that there'll be some, investors are allowed to invest more, or you can raise more. That's all product related. So we spent a lot of time focusing on making sure that that product is going to be ready on the date that the laws go effective, and that the founders who have, either onboarded already or who are currently onboarding, waiting for the official changes to take place, will be able to, pursue their goals of a multiple $1 million raise utilizing the Reg CF exemption. So that's, what I've been focusing on, my team has been focusing on, and we're really excited and, looking forward to, further executing on these plans.
Yeah, just to add to that, what's really encouraging to me, we've seen a lot of growth on the WeFunder team over the last 12 months. So if you look at Q4 2020, we were about 4.5x up on Q4 2019 in terms of investment volume. 2021 has started really strongly already, and it's before the law changes came into effect. So I think already, more and more founders are seeing this working, seeing this as a pretty attractive alternative option for them in terms of raising capital, making it easier for them to raise capital from their community, as well as, millionaires and billionaires and institutions, but also as a way to, recruit an army of brand ambassadors and champions who can help them and support them as they undertake the Herculean task of trying to start a startup. So already I think more and more founders are, having great experiences and telling other founders to do this. We're seeing growth. And then when you add on top of that, above all, like the increase in the max amount from 1.07 million to 5 million that startups can raise every 12 months, and other changes as well, in testing the waters. I'm sure we'll talk about enabling accredited investors to invest in unlimited amount in Reg CF deals, just as they've always been able to invest in Reg D deals. It just kind of makes logical sense. So there's other components to it as well. But we're expecting, I'm sure, Howard and Shahar as well, just like unbelievable growth in the sector over the coming years. And yeah, we've been working very, very hard for a number of months now to get ready and prepare, and we feel like we're in a really good place.
Got it. Howard, did you have any thoughts to add here?
Well, I want to say that 5 years ago when this came out, it was very hard to convince companies to use equity crowdfunding. There was a lot of unknowns. They weren't sure if that was even legal. I think what's amazing to watch today is that it's come around, and I think the pandemic is one of the silver linings of it. It's just people recognize that this is a new form of raising capital that was not available previously, and they take it very seriously. And when the SEC decided to raise it to 5 million, I think this took a whole new life of excitement, of adoption. We have so many companies today who are coming to see us who otherwise probably wouldn't. Even though we were doing the Regulation A for raising 10, 20, 30 million for companies, that was not enough. People thought it was just too hard. You have to do all this paperwork and legal challenges, where regulation crowdfunding has always been viewed as something that is very accessible for companies. And so I think if you look at what Martha Miller did with her group, it's unbelievable. They're the greatest advocates for us at the SEC. They're putting together all of the reports, and I've read pretty much all of them they've published. Is basically saying, look, this country needs a way for entrepreneurs, small businesses, people from every walks of shape and background of anywhere to raise money, and so that the elite are still doing what they're doing, the venture capitalists and all of the different people who are, I would call them the institutional capital, can continue doing their work. But we, as a community of equity crowdfunding, can now emerge and probably take over the majority of what companies need in terms of their access to capital. And I think it's clear to me right now it is the future of finance, and I'm so happy to see our community, WeFunder and Republic here, because they're great companies.
Can I just get one tangible example of that as well? I spoke to a YC founder last week who he explicitly said at 1.07 million it didn't make sense for me. But now with a cap of 5 million, let's go. And that I think is a really cool example because, we'll talk about investor education and communication of, valuation versus stock price was one of the questions we had, great stuff. That's all important. Prevention of fraud and abuse, etc. But I think our perspective is a very, very important aspect of ensuring that retail investors, everyday people, can generate returns from investing in startups on platforms like WeFunder is that we get the best companies onto these platforms and using regulation crowdfunding as opposed to going the more conventional route of angels and VCs. I always give one example of Jason Calacanis, who, as I understand the story, invested $25K in Uber, seed round of Uber, and at their IPO made $125 million, 5,000 extra turns. Imagine if that, instead of him making 125 million more, imagine if that had gone to 125 people who had invested $200 each in their seed round, now all becoming millionaires. And so, if we can get the next Uber, the next Airbnb, onto regulation crowdfunding and enable ordinary people to participate in the wealth that they create, that's really exciting. I think the 5 million cap will help us to do that over the coming months and years.
It's amazing you mentioned Jason Calacanis because he reviewed Start Engine when we started and was just dissing us like you cannot imagine. They're like, oh, this is not real, this is crazy, and why would we allow ordinary people to invest? It's unbelievable how he cannot see further. That for him, it's, of course he should be able to invest in Uber. He's rich. He's accredited. Great. And what about everybody else? That type of arrogance is insane. And to me, we're going to vindicate this. We're going to show that actually ordinary people, Main Street, deserve an opportunity to have access to the great next thing. Understanding there's a lot of risk, but please, this has to stop. This elitism, this arrogance has to end. And I hope, Chandra, with all the work you're doing in that leadership, is going to bring it out there and let the people speak. And that, I think, is important.
Oh, go ahead, Jeff.
Jason, though, has definitely become a major supporter and fan of investment crowdfunding. He and I go way back. He's a true supporter of Republic, has sent us dozens of companies and more than likely will continue to. But I think Howard, you definitely hit the head on the nail earlier when he said 5 years ago, it was really difficult to get people to move forward at every step of the way. There are so many stereotypes out there. There are so many stakeholders who wouldn't allow companies to do it. We all did our part in pounding the pavement and educating all those different groups. I think with this rule change on the horizon, it's at a perfect time where it's multiplying the work that we've done. There's been a bit of like a snowball effect that's been created over the years, and it's getting bigger and bigger. It rolls down the hill. Now that's being accelerated because of these rule changes, and it's pretty powerful. But it's not going to be like a flip the light situation for platforms and for founders. There's still a lot of work that has to go into it. Just because you can raise $5 million doesn't mean that everyone's going to. You have to put in the work, and you have to listen to the platforms, follow their best practices and tips, do the things that you need to do, and actually be a participant in the actual campaign. It's a lot of it. It's like going to the mountaintops and exposing yourself and screaming from the top and letting everyone know about it. You can't be shy. If you're going to be any part like bit shy, you're not going to come close to 5 million, no matter how good the platform is or how good your opportunity is. People need to know about it, and then from there you'll start to see another snowball effect, another acceleration. Once these successes happen and the story gets out there, but the thing that will be the major change or major positive result in the industry is when you do have an Uber, when you do have the crowd with an actual positive exit. They've got money back in their pocket from an equity stake, or it's going to be a revenue share or a fixed income deal. Money back in people's pockets is going to create stories and accelerate this industry to levels that we can't even fathom right now.
I'm rooting for Chuck as the next bestie guestie on the All-In pod with Jay Cal and Sean.
So I wanted to touch on something just for folks that may not have a full understanding of the difference or the the difference in being able to raise 1.07 million and 5 million. And Johnny, you said, you mentioned the story about how the founder came to you and said, you know, the 1 million cap doesn't make sense for them, but the 5 million cap does make sense. And so I wanted to double click on that and get more detailed into what that actually means, like why it's more valuable, because there's folks in the audience that don't have a tangible example of why it would be more beneficial or efficient for them to raise with a $5 million cap. So I don't know if somebody on the panel wants to kind of get a little more granular there for the folks that don't have the context.
I can give a couple of examples. I think there are a couple of maybe costs to running a RegCF campaign, regulation crowdfunding, say RegCF. So you need to, if you're raising more than 250K, you need to have a CPA do a review of your financials, and that, depending on the stage of your company and how complex your financials are, you need to pay the CPA to do that, so probably a few $1,000s. And so obviously if you have a larger amount that you're raising, any fixed costs associated with the campaign, usually that's the main one, but if you're running a price round, we have template contracts. We use a YC Post Money Safe, but WeFunder, we use a Cooley convertible note. But if you're raising on a price round, you want to have a lawyer draft a subscription agreement, so that's another fixed cost. So obviously if you're raising 5 million versus 4 million, the kind of percentage cost of the capital is coming down. But another cost, that is kind of maybe not a financial cost, but I usually say one of the kind of downsides of raising on RegCF is that you do need to publicly, downsides in quotes there, you do need to publicly share your financials, right? You need to put that out there on the SEC database. People can see that. Your competitors can see that. And so, it's high level P&L, cash flow, balance sheet. And obviously, we would argue for the most part that startups are going to win by executing as opposed to, kind of worrying about kind of what their competitors are doing. But that is a concern that some founders have. And again, I think if you're able to raise 1.7 million, maybe the value that you derive doesn't kind of compensate for that potential risk or downside, whereas if you raise 5 million, then it can do. So those are two tactical examples. I don't know if Chuck or Howard would have anything to add to that.
Yeah, so I would like to say that we talk to thousands of entrepreneurs every month. And what we find is that the $1 million, even though I think it's a lot of money for a company, they feel it's not sufficient given what they read out there, that some people are raising multi-million-dollar raises for seed rounds, initial rounds, and even second-level rounds. I think the number 5 is so inspirational. I mean, it's true, and I think the balance right. It's not everybody's going to be able to raise 5 for sure. And it's, by the way, 5 per year. It's not 5 million and you're done. Every year you can raise 5 million. That's quite a lot of money. If a company raises 15 million, they will use that money over the next 2 to 3 years. So in a way, regulation crowdfunding at 5 million, it's like raising 10 to 15 million if you get there, because you could raise 5 a year. It's a lot of money. So I think this has opened up the opportunity for many more entrepreneurs. And so for example, we had last year probably over 50 companies who've reached close to $1 million. And then what? Then they're done, right? They that's all they can do. And now they can come back March 15 and add another 4. Now, I don't know. I think that's pretty amazing. And all of this because of the SEC's new rule. They can now come back March 15th, raise $4 million. I think that's a lot. And so we found that for entrepreneurs, it's very hard for them to go through all these rules and understand them and figure out all the requirements like the CPA or no CPA. So we've put together a lot of support. We've hired a lot of people who understand those details so that it makes it more reachable, right? Easier. Help with the marketing. I mean, equity crowdfunding, unfortunately, is not easy to use. It's not as simple as going on Kickstarter and putting your campaign. This is a lot of work. Like I think Chuck was mentioning it. It's tremendous. We ask the entrepreneur to put themselves out there. That's true. On the other hand, we're here as platforms to help and service these entrepreneurs. So I think the future is just amazing. I'm really psyched.
I'd say too that, a rising tide lifts all boats, and not everyone in this call is a tech startup looking to scale where they would need $2, $5, $10, $20 million, whatever it may take. I think one of the groups that will benefit from this growth will be small and medium-sized businesses. As more eyes are on this industry, more companies come to raise, more have success, that's going to be really backed by investors. And then small and medium-sized businesses who need to raise, say, $200,000, $500,000, $1 million to open their second or third store or move across state lines, try to take over a region with their brick-and-mortar operation, they will benefit from that activity and from that investor interest, maybe even more than some of the tech companies will by having the ability to raise that much.
Got it. Harold, I want to bring you in if you're available. If not, okay, go ahead.
Yeah, I think that y'all are hitting on a lot of the same points. I think that oftentimes we talk about startups and we talk about access to capital. We forget that 98% of companies never raise traditional venture capital, yet there's still these organizations, there's small businesses that need to figure out ways to fund themselves. So I wanted to bring Martha back in. Martha, obviously these rules are built, and we see that, Republic, WeFunder, Start Engine, and all the others are the ones who are getting a lot of the attention. Are you seeing any other platforms, any other organizations that are trying to figure out ways to find money and capital for more Main Street businesses that may in some cases be not traditionally looked at in the same light? That you can kind of let us know a little bit more about what y'all's thoughts are in getting capital to those companies.
Yeah, that's a great question, Harold. I mean, there's a lot of different portals. We've got 3 fantastic ones on today, but there's multiple different portals, and I think each one is approaching their mission a little bit differently. I think if you line each of them up, they would talk a little bit differently about their strategy, the types of companies that they're working with. I think that one thing that we have seen, I can't give any sorts of endorsements for any specific portals, but one thing that we have seen that I think is particularly interesting, there are some portals that are looking at more of a revenue share / debt model, trying to figure that out for companies that are more of the traditional Main Street business, where the community and those who are local to the company really want to back it. This year's been a big year for crowdfunding, and I'd love to hear some of our other panelists talk a little bit about what they have seen trends-wise, because something, I think, Harold, to that point, with COVID-19 affecting small businesses and your Main Street style businesses so dramatically, there has been, I think, an increased attention to, you're doing everything else online. You're using, I think we've all got Zoom fatigue at this point, but you're doing everything in front of a screen these days. Can you raise capital online using crowdfunding in a way that people weren't really paying as much attention to? And so one statistic that really jumped out at our team, and it's something in the report that Howard gave a wonderful plug for, and would encourage you to check that out on our website, which is sec.gov/OASB. But in July and August of 2020, so just this past summer, companies raised the same amount of capital using crowdfunding as was raised during the entire first year of crowdfunding. And that's equity crowdfunding, of course. And I think that really bears out the level of interest and the need for capital resources that can support companies and for investors who are interested in backing the companies that they know, they care about, the founders that they want to see succeed. And I think that storytelling element is one of the things that makes crowdfunding such a unique community building platform. So welcome additional thoughts that others may have on that topic. That's a great question, Harold.
Yeah, I can jump in there. This is actually something that's near and dear to my heart. As I mentioned earlier, I spent 7 years before WeFunder running the US program at Kiva. So we were making very small microloans up to $25K. Average was $5,000. And the vast majority going to women founders, founders of color. So this is kind of a background I know the CDFI space. One shout out for a platform would be Honeycomb Credit based in Pittsburgh, but they are really focused on kind of might say kind of Main Street small businesses, they do loans. I think the average loan size is significantly smaller than typically Republic, WeFunder, or Start Engine would do. So just shout out to those guys. On the WeFunder side, we are also interested in supporting Main Street businesses and kind of small businesses in quotes, as well as tech startups. We also do allow for rev share deals and kind of interest rate based loans. One cool story is Crooked City Cider, which is a very it was just opening their doors, cider bar in Oakland. They actually did a Kiva loan, and then they went on to do, I think it was a $70,000 campaign on WeFunder. Gage Toner is a restaurant in Brooklyn that raised a couple of $100,000 with us last year, right before the pandemic, and then they were scheduled to open their doors, and then the pandemic hit. And I was talking to their founder actually this morning, and he was just waxing lyrical about how his investors have been super supportive over the last year. They just opened takeout ordering last weekend, and he said that I think it was 350 investors invested in the campaign. 50 of them ordered takeout on that first weekend, and gave him really great feedback. So we definitely are not all about kind of hockey sticking venture backable startups on WeFunder. We're committed to supporting Main Street businesses as well. On the COVID piece, we actually hustled. I was very inspired by how quickly our team hustled at the start of COVID. We spun up an accelerator program focused on startups that were trying to fight the pandemic. We made a number of investments into them. We also launched a COVID loan, an emergency loan for small businesses. It's a very low interest rate loan. We halved our fees on it. It wasn't very popular, to be honest. I think at the time, and probably still, a lot of small business owners that were in existence were looking for grant funding and kind of PPP funding as opposed to taking on additional debt at that time. So we didn't see much uptake on the loan front. But as Martha mentioned, we've seen unbelievable growth over the last 12 months. And I think the pandemic was kind of contributing factor to that, especially in the early days of the pandemic. Some of these kind of founders on the line might resonate with this, but I saw a lot of founders that were finding angel investors back out, and kind of rounds were collapsing. And so I think increasingly founders were looking to regulation crowdfunding as a very attractive alternative option. So I think in 2020, the pandemic actually contributed to the growth of the sector.
Thanks, Johnny. No, I appreciate that. And I think obviously when it comes to COVID-19, as we look at the impacts of it, I mean, Martha's already stated some of the statistics, and it's great to hear that the platforms are doing different things. I wanted to ask another question, but I didn't know if Chuck or Howard wanted to say anything about COVID-19 before I asked one of the questions from the audience.
We were really appreciative of what the SEC had allowed, which was to have companies move forward with the campaign without having a financial review on a raise up to $250,000. That clears the path for on the Republic side to move forward quicker who needed to. They still had runway, they still had business life and activity, but with the ongoing pandemic, even 2, 4, 6 weeks of time saved, meant a difference to them. If anything, it was just, a psyche difference, a mental difference, but that was really well received with a lot of founders in our pipeline, and we were super appreciative that rule was made specifically because of the pandemic. I believe that's going to continue, but Martha might have to speak to that.
Yeah, I appreciate you flagging. Oh yeah, I was just going to say, Chuck, I appreciate you flagging how much that meant. I think that really, I know that there's a number of members of our team who are in the audience right now, and so that gives an opportunity to give kudos to them, because when the pandemic started, our team, everything went, virtual, and we were all scrambling to figure out life. But the big thing that was most important for our team was figuring out how do we shift and make sure that the capital raising tools support the companies that are struggling the most right now. And we knew the statistics. I think, Chuck, you were highlighting it, how little cash sits in the bank account for most smaller businesses, and how dire of straits they were in. They didn't have the bandwidth and the lead time to prep the offering with a normal process. We wanted to make sure that the disclosures were still good, that investors were still protected, but figured out a creative solution that could get to the same result of a funded offering that had good financial disclosures, but that got us there more quickly so that the companies could make it past those different hurdles that were coming their way. And so that's just a real testament to creativity and the work behind the scenes that our team members did, working on a solution and engaging with platforms and companies and coming up with something. And I think what is practically record speed in regulatory world, so getting that out the door in May. That was temporary conditional release. So some of those short time frames are going to expire at the end of February. And there are some other elements of that expire in August of 2022. Those extensions were put into place in the larger adopting release that made effective the new crowdfunding rules. So the things that were most exciting, I think, in that release was that $5 million number. That's what everybody's focused on. But that same package extended some of that temporary COVID relief to make sure that companies still had that as a ramp to success.
Absolutely. And we definitely appreciate that. I can speak for the founder community that's raised and understand how, in some cases, especially now that you have the ability to do a roll and close, as in be able to withdraw some of what you've raised as your campaign continues, that probably helps a lot of companies keep going. So I want to talk a little bit more about the investor side of this. We talk a lot on the entrepreneur side, and for those of you who are joining us, this is What's New with RegCF, where we are talking with representatives from WeFunder, Start Engine, Republic, as well as Martha Miller, Director of the Securities and Exchange Commission. And one of the conversations that came up on Twitter, so it's an audience question, but we were kind of prepared for it, was what are the ways to better educate new investors about valuations, potentially predatory campaigns, and to kind of combine that, how should entrepreneurs be talking about their investment opportunities to potential investors? And so, Martha, I know that you all hosted a webinar just a week or two ago where you talked a little bit about the ways in which you wanted to meet people where they were to help educate the investor population. So I wanted to start with you. What are ways that the SEC approves of and the way that founders and the folks who are raising money to talk about what you could expect as a person who's investing in this company? And then I want to toss it to the representatives from the platforms to talk a little bit about how you all work with the founders to make sure that their marketing messaging isn't saying anything it shouldn't be, that they are being reasonable with their valuations, and that they're being mindful of the audience that they're taking money from. So I want to start with Martha and then go to the rest of the folks.
Yeah, Harold. So I've got a two-pronged answer for you on that, and that is something that's near one of the topics that you bring up on education of both the investors in small businesses as well as entrepreneurs who are raising capital is critical to our office's mission. As you asked the question about valuations, it makes me chuckle because before being in this role was a lawyer that was advising. In some cases, I was working on behalf of the investors, and sometimes I was representing the founders. And man, valuations are one of the most difficult conversations in figuring out what, particularly for a pre-revenue company, where do you peg that number? And the most important thing that I would always, when I was wearing the hat of the advisor, was to advise the company it's got to be a balanced valuation. And the investors have got to understand and ultimately agree with the economic terms that you're coming up with. That is absolutely critical. Now that I wear the government SEC hat, instead of being the advisor to those companies, one of the important differentiations is that we're not merit regulators at the SEC. And what that means is we don't weigh in on the deal terms, but instead whether you have followed the technical requirements to allow you to use regulation crowdfunding as an offering type. So I think this is a wonderful opportunity. I know that a lot of portals have been really active trying to help coach along some of the companies that want to lift and to help them strike that right balance so that investors aren't walking away feeling like they have not gotten a fair deal, and that there are good expectations and a good understanding of what that economic arrangement really looks like. I will say the most critical piece from our perspective at the SEC is that companies make meaningful disclosure to their investors, and that the investors, if you are thinking about investing using crowdfunding, that you know what you're doing and you pay attention, you read up, check out investor.gov if you are looking for resources on how to become an investor, how to diversify your portfolio. But I think this is, Harold, a wonderful question to get some insights from how the portals are looking at this education piece, because I think that together we can all work on solutions to make sure that we have got a well-equipped investor base here.
Martha, we're going to have to make you a moderator if you keep doing up with guys like this. I think that you're tossing it back. This is perfect. Thank you for that. Chuck, let's start with you and then go to Howard. I think Johnny spoke last. So Chuck, let's go with you and then go to Howard.
Cool. I'll say, for investors, it's power to the people. We're at the beginning of a retail revolution. You've all seen the news, Robinhood, CME, Reddit. That's just the beginning, at least in my opinion it is. And it's on all of us on this panel and probably even a lot of the people in this room to educate investors. There's a mountain of content that can be and will start to be distributed by my team to investors to educate them on, as simple as it can be, investing. When it comes to valuation caps, I think people need to be educated on that, obviously, but there's a lot of reasons for it. There could be strategic reasons. There could be most recent rounds that were closed. An angel investor dropped in $100K at the valuation that you're seeing on the campaign. The way that you find out, just like we do, and this is where investors need to be educated, ask the founder questions. Go on the deal page and ask them questions. Why do you have a $25 million valuation with no revenue? Get to the bottom of it. That's what we do in diligence. We push back on valuation all the time. We've actually rejected companies that have had valuations that we feel are too high, unjustified, doesn't make any sense. We're like, you know what, that is high, but they've been able to justify it through XYZ. That information is disclosed, but there's also thousands of other things disclosed, a pile of written content, and you may not get to it as an investor, but if that's on your mind, or anything is on your mind, you gotta go to the deal page, and we're educating people to do that, to ask the question. Founders love that engagement. They want to engage with investors, so it is on us to further educate the investors. We'll be doing that. We're going to be doing it a lot more often, and I really mean it like power to the people. This is the beginning of a retail revolution, and it's going to be awesome. So that's my take.
Howard or Johnny, did you have any thoughts there?
Yes, actually, I do have some thoughts because I think when we talk about the investor who is going to put their money in a deal, they'll invest and receive securities for what they invest. I have been thinking about this for a long time, and to me, I think one of the important things is transparency, and I think the SEC has done a great job requiring transparency. This idea of commenting on a page is unbelievable. We find stuff from ordinary investors that is incredible, very useful and helpful that we may have not known. And it's just great to see the community get together on a page and comment. And I like the saying that the investors, they have a voice, they have a wisdom. The one thing I'd like to ask Martha is, I've been very focused on the idea that we should provide liquidity to these investors. The idea that the regulation does provide it. It says that after 1 year, you invest in these companies. 1 year later, the securities can be transferred. And so I'm curious, Martha, what thinking are you guys doing in terms of making this more a reality, where those laws that are in every state, there's 50 states and they each have different laws for allowing liquidity. What are you doing that could really change things radically and allow these investors to have access to liquidity?
That's a great question, Howard, and one that we hear about often. And for those who are tuning in, they're thinking, okay, liquidity. You may have also heard it referred to as secondaries or secondary transactions. So that's the trading that happens after you have bought the securities directly from the company. And it's a topic that is really important because it's how a lot of people are looking at freeing up the cash they've put into an investment. So when you're investing on crowdfunding or using anything else that is not a public offering where you have kind of that daily liquidity that happens for being able to trade on the stock market with other sellers, you have to invest knowing that your capital is going to be locked up until a more rare transaction event occurs. And so, Howard, I think that that's a wonderful question. It's something that we hear a lot about, and we welcome feedback. It's not something that we have heard quite as much about in the crowdfunding context lately. It is something that we hear a lot about with later stage companies where cash has been sitting in the company and the investors have been holding on to it, and particularly in a fund structure, they may be reaching the end of that investment period where the fund needs to return capital to the investors. It's something I would welcome thoughts that you have on what the solution needs to look like with respect to the crowdfunding space, because I agree that it is an important topic, and no one is investing without expectation. The important part about investing is the expectation of a return. And so that is one big important piece of the return, is what that liquidity event looks like. So I welcome solutions and ways that you are thinking about how we should approach it, because what we do needs to be driven by what the market needs.
Yeah, absolutely, Martha. And one of the things is what is amazing about regulation crowdfunding is how you were able to preempt the rules of every state. So you preempted all the blue sky rules for issuing the shares using regulation crowdfunding. That is unbelievable. It cuts so much paperwork. It's incredible. You really figured it out. What about preempting all the blue sky rules for secondary trades?
That is a great question and a topic that I'm happy to delve into at some point, but not one that we have, candidly, that's not one that we have heard a lot about. It's certainly something that was raised in, I think, a few of the comment letters on the proposals for the changes to crowdfunding, but not something that there was, at the time, I don't believe, quite as much support and momentum behind. But I welcome additional feedback there on whether you think that's something that the Commission needs to be looking at and the impact that would have on investors.
So I want to hold that for another conversation. And before we move on to the next question, I do want to just reset the room really quickly. So if you are listening, then you are listening to us talk about the new regulation CF rules that are dropping in March. We have Martha Mills, who is a director at the SEC. We have Johnny from WeFunder, Chuck Pettit from Republic, and Howard Marks from Start Engine. And so we are engaging them in a discussion around the new CF rules from both the entrepreneur side and the investor side, trying to understand how to use those rules to our advantage, how to get more underrepresented founders onto these platforms, how they can use some of the changes to their advantage to be able to raise more money than they were previously able to. And before we move to the next question, we're almost up at the hour mark, and we want to be able to ask your questions. So if you're listening and you do have questions, please use the hashtag #NewCFRules on Twitter to ask your questions. You can also DM Harold and I, and Stephen Green, who is our friend and fellow Black Founders Club admin. You can DM any of us, and we'll be able to ask the questions to the folks that are on stage. But the next question that I want to pose to everyone, since we're talking about the investor side of things, for those that are actually at platforms, I have some questions around investor behavior, right? Are they mainly coming on the platform, sticking to one company, or when you talk about community, right? If a company is raising on, let's say, WeFunder, for example, they're bringing on their community. Do the investors then say, I want to look at some other companies that are also crowdfunding? What's the behavior there, and how do we better extend investors' ability to invest in other companies other than the company that brought them to the platform?
I'm going to jump in right away because there's actually something that Martha just said that is related to this, and I think it's actually a great tip for all the founders in the room who are considering running an investment crowdfunding campaign. She mentioned something along the lines of investors have expectations of returns. If you as a founder can appreciate and understand that, you will have a much more successful campaign. One of the stereotypes that we all battled with over the years and still do even today is that there is a belief that retail, non-accredited investors aren't sophisticated. If you can also put that to rest and consider them sophisticated, because the vast majority are. I've seen it. I'm sure Johnny and Howard have seen it hundreds, if not thousands of times over their careers in this industry. People are sophisticated, whether they're putting in $20 or $20,000 or $100,000 through Reg CF. They all want, the majority want and expect a return on investment. So keep that in your mind if you're going to run a campaign, because I think it can help have a successful campaign. I'm sorry, I'm a little bit. I'm really passionate about investors and them getting their respect, but Chandra, I forgot what's the actual question.
I mean, I think you hit it, but the question was more about, I love that. I mean, you came off mute and you like went straight into it. Love it. So the question was more about, are you seeing investors come on for one campaign and then bleeding into others, and then like, what's the process there? How do we get more investors to additional campaigns once they come on for the company that they were initially brought on the platform for?
In the current state, it's taken time. So you have batches of new investors from 4 years ago who have now invested in between 15 and 25 companies. People who just started a year ago have maybe only done like 1 to 5. Part of that is being educated to understand that they can utilize this to help diversify their portfolio to get more alpha out of their investment portfolio. And I think with this acceleration of eyes on the industry, with it actually starting to become mainstream and starting to get into the talks that asset management companies, you're going to see an acceleration of education and people making more and more investments utilizing platforms like the 3 that are here tonight.
Johnny, I saw you up. There you go. Go ahead.
Yeah, I can put some stats around that on the WeFunder side. So the majority of WeFunder investors have actually only made one investment, but probably about 30-40% have made at least 2. And then as Chuck mentioned, there's a long tail. I think there's one that's made like over 200 investments, which I find pretty inspiring. On average, Founder is going to raise about half of the capital from existing WeFunder investors, and half from first-time investors who, they might be bringing to the campaign. And that number varies, right? So, for example, Y Combinator founders we've seen will raise about 75% of the capital from existing WeFunder investors. So if the investment opportunity really pops, e.g. with the YC brand, or it's a really hot sector, or whatever the reason is, they've got a hockey stick growth chart, then I think that founder can pull in relatively more from existing investors. If it doesn't catch the eye of our investors, then the founder kind of has to work harder in pulling in investment volume from their own network. I talk about kind of 3 buckets of where founders might pull capital from to run a Reg CF campaign. The first we were just talking about is like the existing investors on the platform, right? So you get in front of WeFunder investors, Republic investors, and they're going to bring a significant proportion of your campaign. Then there's kind of people that are in your first degree network, and that might be angel investors that you're bringing into the campaign. It might be friends and family. It might be your LinkedIn connections. It might be your customers that you can send an email to. And then there's a third group as well, which is, people that you market the campaign to that you might not necessarily know, and they might not necessarily know WeFunder. But one of my favorite WeFunder campaigns is one called Black Sands Entertainment, a comic company. They had 2,766 investors on WeFunder, and they ran a campaign with us last year. And, you read some of the comments on there, like I'm reading one, I'm executive director of the African American Museum of Cleveland, and what you're doing will have a positive impact on our children for generations. And, you read, there's 1,500 comments on their WeFunder campaign, and we have a Slack channel where all these comments are coming through. It's truly inspiring oftentimes just to spend a few minutes reading through these investor comments. But you can tell a lot of these investors had never heard of Black Sands before, but maybe they saw them on a Clubhouse show or a podcast, or saw them in the local paper or wherever it was, social media posts. And so what Reg CF allows founders to do is not just tap into their own network and raise money from unaccredited investors in their own network, as well as accredited investors, but also market the company and the investment opportunity to people that might be passionate about what they're doing or interested in learning more.
All right. Before I throw to Harold to ask the next question, I wanted to see if Howard had any thoughts there.
Yeah, I want to echo what Johnny and Chuck have said. We see, again, a majority of investors, they put one or two investments, which is, I believe, not adequate. They really should have a portfolio, but that's an education piece that we need to work harder on as a marketplace, all of us, to really get the idea that portfolio is more powerful than just one investment. However, that said, I don't blame them because, they don't know when they're going to get a return. It's not clear as to when they're returned. So if we can work as a marketplace to give them a better sense of what and when they can get a return on investment, I think you'll see an explosion. I think for us to go from where we are today, 3 platforms raising 100+ million a year to raising billions a year, is we need to be able to crack that. That is, to me, the key for the investors. Say, hey, you know what? I'm like the VC. I'm like the top angel right now. I put in $1,000 among 10 companies, and I took out through 4,000. I mean, that to me that would speak louder than anything else. Yes, we can educate the investor, and we should, and we want to, but there's nothing like it giving them a sense of the ability to get a return, and I think we can do better than what we're doing now.
On this question as well of the platforms investors reinvesting and building up a portfolio of investors. One thing I think is really cool here, Chuck again alluded to this, we're on the right side of a trend here, right? I talk about network effects in this business. More founders on platforms like WeFunder, better founders with the 5 million cap, that's better for investors because they have more opportunities to consider investing in. And then, for investors, it's better for founders because they can then raise more capital from the existing investors on the platform. So just like with Uber, right, more drivers is better for passengers and vice versa. I think there are very, very powerful network effects in this business. So if when we came out of the gates in May 2016, right, it's like 9,000 investors on WeFunder. Now there's 900,000. And that's just a lot more eyeballs that we can put our founders in front of. And that's just going to become more and more the case over time.
And I think some of this, too, is kind of breaking away from the idea that this is just equity crowdfunding. So I know it's a nomenclature thing and whatnot, but there is revenue share agreements. There are revenue share agreements. There are debt agreements. We're sending something like $400,000 per month back to investors from previous debt deals. With our video game business, we'll probably and hopefully likely see that double or even quadruple it in the next 2 years. As we continue to scratch the surface and go further into small and medium-sized businesses, we're going to start to see a lot of money going back to investors' pockets, and that's a huge thing. Add in a couple equity deals that have massive 20, 40, 60 X's on their exits, and then the stories become even more powerful. We're probably all still pretty far away from those things happening, but we all each know of some in our portfolio that are getting close, and that's going to be some major moments for the industry when they happen.
Awesome. That's actually right up the alley of the conversation I wanted to have next. So I had a question. Again, thank y'all for tuning in. This is What's New with RegCF, hosted by the Black Founders Club. I appreciate not only Martha Miller from the Securities Exchange Commission, but Chuck, Johnny, and Howard from Republic, WeFunder, and Start Engine for being with us tonight. So I had a quick question in regards to that. When we talk about liquidity and ROI and the opportunities there, I obviously participate in equity crowdfunding as a big champion of it, and I do, one of my favorite deals, Cash Me Out, right? So they have the right as founders to say, we're going to buy back the equity crowdfunding participants, and now they've gone on to raise billions of dollars, and so my return was, I think about 150% or 200%. Recently on social media, there was another platform where a company just got acquired, liquidity event, but due to the way the deal was structured, I think investors got 50% return on their money. Could you talk a little bit about what this means for the future of this? Like, how big of returns do you all have to deliver for folks to say this is life-changing money. And I bring that up because Howard kind of teed it up earlier, saying like, what would it have meant like if Uber would have raised on here and all these people would have raised? I think it's Howard. But like, how do you get that company on? So there's one part. But the other part, which I'm more so talking about now, is what are the types of returns you all are seeing that are changing lives of investors or really outsized returns? Because to me, at 150%, it doesn't really do much. It's like, oh, I was great, kind of supporting them. Are y'all seeing something much larger than that? And what are you all going to kind of prepare your investors for saying like, yeah, unfortunately, this is something that can happen?
Yeah, that's a great question. I can jump in on the WeFunder side. So we think very, very hard about this, and are trying to, as everyone on this call is trying to build the infrastructure here in a way that is enabling investors to make returns long term. And so a product change we made last year, which I think was a very, very good one, was that we rolled individual investors up to one line on the cap table using a custodian structure. Starting should have done the same thing. Republic use a CrowdSafe. That's critically important because founders don't want 1,000 lines on the cap table. That's really a deal breaker. But we also now have lead investors who are basically proxied. They have the voting proxy for the individual investors. Because we saw, I think I might know the example that you took about there, Harold, but we saw this happen one time and saw the risk of it happening again. And so what we're trying to do with this lead investor structure is protect investors so that, if there's a VC who comes in the next round and, wants to kind of, take out the retail investors, they have representation, they have a voting block that they can use to kind of, retain their investments, and so they can be in for the long ride, the long haul, all the way through to the IPO, unless they obviously want to get liquidity on the secondary, as Howard mentioned earlier. But that lead investor product change was, for me, the most powerful example of something we're trying to build into the product at WeFunder to try to address that concern.
On our side, we don't allow this type of option where the company can buy out the investors on a favorable term for the company. We just don't believe in it. We think the investors should be protected from that. That's why we believe in mostly equity, a lot of the other synthetic derivatives like SAFEs that you hear about. We believe that the investors should have voting rights protection, and equity provides that, by the way. And we also believe in liquidity, and that's why we got finally a license to be able to provide liquidity to investors. And we're working very hard with companies to convince them that they should do that and provide that option of liquidity for investors. We believe very strongly in that. And investor protection is a big deal, because I know the SEC, that's one of their mandates, is to protect investors. Obviously, they have to also help capitalize companies. That's another mandate. They have a third mandate, which is to create markets that are well run. And we believe the same. We believe the same thing as the SEC. All three things we believe are critical. So for us to take our marketplace, and with the other platforms like on this call, this show today, we really need to solve this, because the idea that Harold gets 150% of his money when the founders or other people are going to get paid on 20 times the money, to me, I find it just not right. And we need to solve it. And how? That means that our platforms, especially StartEngine and the other platforms, have to watch out for that and not allow these kinds of things to happen, because that's where the sophisticated investors laugh. And they're like, I told you these people are not that smart because they invested in this kind of instrument. But the reality is they probably didn't understand it, that they had a cap on their return. They probably didn't get it, that there was a call option. And so I think it's our responsibility to make sure that the investors are protected. And I have to tell you, StartEngine, we talk about it all the time, and we take it very, very seriously.
It's all right.
Go ahead, Martha.
I was just going to jump in there and say that I think to that point, it is so critical for companies that are listening to make sure you understand when you are preparing the documents and working with lawyers to prep your deal docs, what are the investors' expectations and how are you communicating the terms of the investment, and do they understand what the terms are and how the upside works? Unlike debt where you're returning principal plus some interest, with an equity deal, you're typically not limiting upside. That's not generally the expectation. And investors are taking a big chance when they're investing in an early stage company. And so this kind of maneuver is the kind of thing that gets people pretty ruffled. It not only can give the company a bad reputation and get people fired up on social media and otherwise, but it can take crowdfunding. It's something that I welcome solutions, and I love hearing that the portals are working on ways to make sure this is not the experience that investors have when they are coming to crowdfunding portals. So, Chuck, I'll pass the mic back over to you. Didn't mean to jump back in.
Yeah, no worries. I was going to say, and I'll own up to it. I think, Harold, I know the deal that you're talking about. That was the one time that we allowed it, and the only time that we've allowed it since. It was a unique situation where their attorney was very adamant about it. We were very adamant about getting the deal launched because we did think it was a viable opportunity. Now, if I'm correct on that assumption that it is that one deal, you have realized that. I think it was 200%, but the rest is just paper. So I do have some good feelings that it's just paper beyond that, and that they actually haven't had an exit. They have 1 million miles to go. It will suck and be, not a good situation if they go on to exit at 20, 30, 50x or whatever it may be. But we definitely had investors' best interest in mind just to get that deal live because it was a good opportunity. We did disclose it properly. I think we actually had it, and I don't know if you remember it at the time, but there was a couple different things on the actual deal page that described it as well. So we wanted to make sure that people were aware of it going into it, and unfortunately it happened. I went to bat with the founder and their attorneys multiple times post that campaign to try to get them to change their mind if that was going to happen, because they had the option not to do it, but they decided not to. So that's our plan. We look like the villains I don't want to see. But
well, here's the thing. So first off, I appreciate you because yes, that was my personal experience, but there was another platform not represented on this stage where people were sharing about their experience where the company was recently acquired. So they're full through the exit, but the investors got 200%, I guess, as you were saying, Chuck. So, yeah, this is not a thing that we want to see going forward, but I think that's the thing that I had as a founder who raised on equity crowdfunding in 2018. The thing I recognize is, y'all are startups too, right? I think that that's something that a lot of folks may not recognize, but you've got to learn, as the founder who's trying to raise money, the investor, we've got to educate it not to cut a check and expect that they're going to, not drive you all crazy. Then you got to deal with the SEC and any regulations. And so I give a lot of grace to the platforms, especially for being aware of the challenges and trying to make this better for everyone. So no, I appreciate you chiming in there. Chuck, I wasn't going to put you on the spot. I just know that I think that we should try to figure out what the big stories are. I think there was a company based in Europe, somewhere in the UK, that had some insane returns for their equity crowdfunding. So before I toss it back to Chandra, first I'll remind you all, if you have questions, please tweet us, #CFRules. But to all of you on the platform or on the stage still, do you mind giving 30 seconds about the biggest return that you all had and how that community was able to participate? I would love to think, given the platform we have, folks listening, I think that would help instill more confidence, letting folks know, hey, this company raised from 472 people, and that ended up turning into this liquidity event. So if you put in why, that person did pretty well. Do y'all have any stories that you would like to kind of tee up and talk a little bit about success stories from your various platforms? And you don't have to actually say the name of the company if you can't.
Yeah, I can talk to you to some of the WeFunder examples. I mean, the best examples right now are on paper, right? If I go back to some of the earlier cohorts of companies on WeFunder before the rules were rolled out in May 2016 for Reg CF, we were doing Reg D investments, and we actually got into 4 unicorns, the most kind of explosive one being Zenefits. So that's all on paper at this stage, as Chuck mentioned. But also we're trying to be transparent here. If you go to wefunder.com/results, you can find a list both from the Reg D portfolio and the Reg CF portfolio of where we are at. It's obviously difficult to kind of track that information super comprehensively, but we're trying to do what we can.
Sure. All right. Well, I appreciate that. I think that's something that we definitely want to see more of. Obviously, as equity crowdfunding investors become more sophisticated, as Chuck is illuminated, like we know that the market is educated and is getting more and more sharp. At some point, it's going to be, should I be writing a $1,000 check to this company via a platform, or should I consider just doing a syndicate via some of these other platforms? And so there's all these nuances and unique things. So I definitely appreciate y'all sharing some of that. Chandra, I'll toss it back to you for the next question.
Okay, so we're going to switch it up a little bit. Thank you guys so much for kind of going down that alley with Harold and I. And one of the rules, and I'll start with Martha, that is changing is around campaign solicitation, testing the waters. And I wanted Martha to talk about that, but then kind of going back to what Harold was asking around marketing and how you're preparing companies to market their campaigns. A lot when you're looking at founders in general, but underrepresented founders, they have so much social capital. And how do you tap into that with some of the new rules around testing waters, things like that, to allow them to speak more broadly about their campaign, to market to more folks? Martha, I'll let you start, and then we can go to Chuck, Johnny, and Howard.
Yeah, thank you, Chandra. This is a great question. So testing the waters for those, it is not just something where you dip your toe in and try to figure out, is it warm enough yet to swim? But the analogy is appropriate here because what it really comes down to is figuring out if this is the right moment and you have things ready to raise capital and getting a sense of if the market is ready for you to jump in. And so part of the amendments that are becoming effective next month include several new ways that companies can communicate with their networks. So additional communications are going to be permitted before a company can determine which exemption they use. So figuring out, is it crowdfunding that's going to be the path that you'll use, or are you going to use one of the other offering tools, like a Reg D private placement? And then once you've chosen to use crowdfunding, but before you filed your Form C, you'll be able to use some additional communications and then have some limited oral communications after the Form C is filed. So some of those materials from communications are supposed to be filed with Form C and may need to have legends. And the reason behind that and the philosophy, and I think it's something that our other panelists have spoken to, is it's important that all of the investors in the crowdfunding campaign have access to the same information that you're sharing. And it's not something where there's DMs with one particular investor or group that others aren't aware of, where questions are getting answered in a vacuum. So what we're trying to do with these rules is to make it where companies have the ability to gauge whether they've got the terms set right and that it is the time to go to the market. And then from there, once they are really communicating on critical things about the offering, that those are accessible to all of the investors and potential investors in that deal. So happy to answer any further questions, but that is, in a nutshell, testing the waters and the changes there. I think it's a really positive development because what it means, and I think that some others have highlighted, you incur costs when you're preparing your financials and your deal documents. And the worst case scenario, I think, for founders, if you're raising money, it means you need money, and you probably don't have this extra cash sitting around to prep some documents before you find out, oops, this isn't the right moment, or we need to show additional traction before investors are interested. The point here is get a sense of whether or not it's the right time for you to go to market, then incur the costs to prepare your Form C and your deal documents so that you're doing so in a really savvy and appropriate manner for your capital raise.
Okay. Oh, I was going to throw it to the platform folks, but Chuck, I see you came off mute, so go ahead.
Yeah, cool. I was going to say, so testing waters is definitely going to be great. This as long as it's used the right way. And by that I mean today Form C is filed, people can start to publicly discuss their campaign, and that's great. When you do that, though, sometimes founders get in the trap where they go out and they say, hey, here I am, look at me, it's the greatest thing ever, you should invest in this. If that's shifted to testing the waters a month prior to the Form C being filed or 2 months prior to the Form C being filed, it's not going to do them any good. They need to go into, and they can leverage testing the waters in a more efficient way, save capital and time that would be spent on filing a Form C, having your financial review, etc., by starting to just warm up the crowd. They need to put their feelers out there and see, yes, you'll see what the interest level is, but you have to communicate to them and be engaging and honest with them, and they'll start to attach themselves to you. I think it's going to be very powerful, too, with founders who they're already active and engaged in social channels, or they have partners or people who are fans of theirs who have active and engaged followers on social platforms who will talk about the deal and draw more attention to it. So there's a build-up of momentum going into the actual campaign. And just to make a bit of a jump, though, I see this a lot, too, with founders who think that influencers can make a world of difference to their campaign. The same problem happens. They fall into the same trap, and they think, if so-and-so influencer says something great about my campaign, it's going to draw in all their social media followers. They'll become investors, and that's going to be the greatest thing. It doesn't work. Working with someone, whether they're a celebrity that's known around the world or someone who just has 200, engaged followers on social media, can be just as impactful, because they're going to have someone that's listening to them. If they're honest and truthful about what the words they're putting out there, that's going to benefit that founder. I think Harold, when he ran his campaign, really opened my eyes to that, because he found someone in his network who had an active following. It wasn't large, maybe it was a couple hundred, maybe just a few thousand, but they all listened to that individual and they appreciated what he had to say. And when he went out and talked about Harold in a meaningful way, it brought attention to Harold's campaign, and then they invested in the campaign, and it actually brought in a lot of money. So if you're leveraging and utilizing testing the waters along those different strategies and in the right way, I think it can be super powerful for companies moving forward. At Republic, we'll be having a lot of companies launch testing the waters campaigns. We'll allow companies who are actively onboarding for Reg CF and even Reg A, which was kind of neglected in this conversation, by the way, but they'll be able to utilize it and kind of get their feet wet before things actually start. So I do see this being a positive change to the industry, and I'm kind of really looking forward to it once and for all, because it's been weird telling people who are so amped up and doing a lot of work to get these things done that they can't talk about it, and just allowing them to be able to is going to be great for everyone.
Yeah, I think just to add on the kind of marketing tactics and how founders can go about marketing the campaign, bunch of different things to check off, right? Getting the campaign page right, as we talked about earlier, getting the terms right, ensuring, the instrument is going to be attractive to investors, the valuation terms, etc. On WeFunder, as I mentioned, we have the lead investor product feature, so finding an awesome lead investor who will lend a ton of credibility to your campaign and hopefully help you promote the raise. One thing I always recommend is don't see this as okay, well, I'm doing Reg CF and so I won't ever talk to any accredited investors or angels. You absolutely want to have those large check investors invest through the campaign to build momentum and, again, add social proof. And then one point will be around leverage. So, by the end of $1 million campaign, you might have thousands of investors now, and they are now owners of the company, and they're your champions, and they want to help you grow, because then the equity investment goes up in value. And probably the most they can help you during the campaign is to get the word out about the campaign so that you raise the round quickly and can get back to running the business and putting that money to work for them. So really thinking about leveraging investors. Obviously, every campaign is different. I'm sure Republic is starting to do a good job of this too, but we have an awesome team, colleagues Justin and Katie, who work with founders who are launching and just basically coming up with a fundraising plan that's best suited to the company. We provide a lot of support to founders in that part of the process.
Okay, so we're coming up around the end of the show, and one of the things that we wanted to give everybody on stage a chance, one of the questions that we wanted to give you guys a chance to answer is, I think Harold has it. Harold, do you have the question?
I have the question.
Go ahead.
I'm remixing it in my head. I got it to a dope beat, everything. We're ready. So first off, I just want to thank everyone for showing up today. Martha, Johnny, Howard, Chuck, thank you so much. Especially my co-host Chandra. Thank y'all for being here. So naturally, we are seeing in a market where there is so much money in the private markets that there are really a lot of opportunities for founders to, find different ways to capitalize their companies. So as we wrap up, I'd love for each of you around the horn, going with the platforms, to talk a little bit about what you see as the biggest opportunity for companies of any kind. And maybe you could talk about the perfect companies for crowdfunding. Talk a little bit about which companies should be crowdfunding on your platforms and why crowdfunding is the future. And more specifically, as we think through that, how do you get those super successful soon-to-be companies that end up being the unicorns I think Johnny referenced? I'd love for each of you to talk as you wrap up on why crowdfunding is the future and the platforms that you're creating are helping them get there. Chandra, just let me know. Those are long answers. So if you want to each talk about future crowdfunding and why companies should be thinking through CF relative to the other options, that would probably be a shorter answer.
Yeah, I'll be short. Today, about 2,000 companies are funded by VCs, and then probably tens of thousands with angels. That is a drop in the bucket. That is nothing compared to our economy. There are 600,000 new businesses created every year. In fact, this year, because of the pandemic, the number of business starts doubled in March. So these are people who had family, maybe have lost their job, but now have dreams, and they want to realize those. And I think, our mission is to help entrepreneurs achieve their dreams. We don't necessarily say, this type of company, because they're VC funded, we should put them on our platform. Not at all. We look for entrepreneurs who are looking for capital to achieve their dreams, and so we're welcome for everybody. As I mentioned, 10% of our founders are African American. We feel that's just the beginning. We think we can do better, and for us, this is what equity crowdfunding is: the future of finance. And the reason is because we're democratizing access to capital.
Thanks, Howard. Johnny and Chuck?
Yeah, absolutely. Well, one thing I'm excited about, especially on this show with this audience, is trying to level the playing field for underrepresented founders. You guys probably know the stats better than me, but I think 1% of VC last year went to Black founders, 3% went to female-only founder teams versus 80% of male-only founder teams. And there's a massive geographic inequity as well. So one of the things, both at Kiva and now at WeFunder, that I'm super excited about is a more democratic approach to raising capital, when the people making the investment decisions aren't, a bunch of billionaire white dudes on Sand Hill Road, but rather, kind of middle-income women of color in Cleveland and Arkansas. Then I think all of us probably on this platform hope this as well, is that you can get more equitable allocations of capital happening, and founders that might typically face maybe discrimination or might have barriers and have more options available to them. And so that's something we're really committed to at WeFunder, and we need to do more there. And that's on both sides of the table, right? It's both enabling underrepresented founders to have kind of alternative avenues for raising capital, but it's also enabling more people of color to become angel investors and lowering the barrier to entry to that. Now, I will say there's still a challenge. This is not a silver bullet, right? When median white household wealth is 170K and median black household wealth is 10K, and with regulation crowdfunding, a lot of it, you're getting the ball rolling with raising from friends and family networks. So if there's less wealth in that network, it's definitely not a level playing field, but I think it's an important step in the right direction. And so for me, something I'm very personally passionate about is, using regulation crowdfunding and WeFunder to get more capital flow to more diverse founders over time.
Thanks, Johnny. And I know we want to wrap up on time. So Chuck, I will give you a little bit to share your thoughts, and then I want to get a closing remark from Martha.
Yeah, this is the future of investing, the future of the investment industry. Every founder should have it as a tool in their toolkit. And when I say every founder, black, brown, yellow, green, gold, whatever, female, male, 45 to 55% of dollars raised on Republic, as we fluctuate between, have gone to underrepresented founders. So I really do mean every founder. I'll leave it at that.
Excellent. Chuck, I appreciate it. Martha, do you have any last words? And then Chandra, you can close us out.
Yes, I will be very brief, and I will start out by saying, Chandra, Harold, thank you. You've been fantastic moderators. And Chuck, Johnny, and Howard, it has been a pleasure to share the stage with you. We talk about entrepreneurs building our future, and investors are bringing the supplies and the toolbox that make it happen. Our team's here to advocate for you. I encourage you to tell us your story, reach out, email us at smallbusiness@sec.gov. And we really want what Arlen Hamilton calls the underestimated. I hate the phrases underserved, underrepresented. I prefer underestimated because that is what I think of when I think about minority and women entrepreneurs. And we want our underestimated founders to thrive and to find the capital needed to build, grow, scale, and bring ideas to fruition. So reach out to us. I hope we can continue the conversation. And tonight has been wonderful. Thanks to everyone in the audience for being here.
All right.
Over to you.
Yeah, so I, again, I think Harold said this earlier, want to say thank you guys for agreeing to join us today. And it was kind of last minute to get everybody on stage, so I really, really appreciate you guys making time. And also really appreciate you going down the road of trying to make equity crowdfunding more accessible to underestimated and women founders, and appreciate the passion that you brought to the stage. And I do want to say that Howard and I are moving over to another room to further talk about getting businesses on the Start Engine platform and just talking about helping them get through some of their challenges. And so I did want to mention that before we close out. And again, thank you, Harold, to my co-host, and thank you guys for joining and listening for the last 90 minutes. Anything else, Harold?
No, I think that's it. If you all want to get the recording of this conversation, go to Luma. So it's lu.ma/new-CS-rules and register so that we can get them to you. Otherwise, message Chandra or I. But again, thank y'all, everyone. Have a great night. And if you are in Texas, find a way to be safe or anywhere else affected by this crazy storm. Thank y'all.
Thanks, guys. Bye-bye.
Thank you. Bye-bye.